Hey, good afternoon, everybody. Going to go over our Forex trades for today, Thursday, January 29th. Finally had some action. As you know, Tuesday, New York City was basically shut down from what was supposed to be a historic snowstorm. Turned out to be about 7 inches of snow. Weathermen totally botched it. But the mayor and the governor of New York, they had shut down the city previously the night before, and didn't allow anyone to drive in. Didn't allow public transportation to get underway until about 7:30, 8 o'clock the next morning. So that means a lot of the desks at the banks, at the hedge funds, were minimally staffed, if anyone there at all. We were actually quite frankly surprised they even opened up the stock market. Um, so we stayed away. We didn't want to get caught in a liquidity trap, which you can really get nailed on. You could have your stop set, but by the time you get out, because the liquidity is not there from so many people being out of the office, you could really get hurt. So we stayed away. And then yesterday was Fed Day, so we don't trade Fed days, although we do monitor what's going on and what the Fed says. Um, Basically, they came out 2 o'clock yesterday afternoon on the East Coast here. Really, obviously they didn't do anything with rates, which we all knew. It was all about their statement. They didn't have a press conference, so they just released a statement. And the statement was basically unchanged from the previous meeting. So it was really a non-event, as it turned out. Um, all eyes now are shifting to when they release the Fed minutes, so we could maybe look into what they were talking about during this 2-day meeting and kind of get a sense on what they're thinking. Right now, Fed funds, the futures for Fed funds, it's about a 50-50 chance that they raise rates in 2015. You got We do this week. We've had a chorus of CEOs coming out. Caterpillar was one of them. I can't remember another. High level CEOs urging the Fed and Janet Yellen not to raise rates until 2016. So it'll be interesting to see if the economy doesn't show the strength that the Fed needs to raise the rates. Um, and you have a chorus of CEOs asking them to delay raising the rates to see what the Fed does. Do they go ahead with their plan anyway to raise rates in 2015, or do they hold off? Markets, as far as equity markets, have been getting beat up lately in the last few days, really because the Fed's. It sounds like, at least from yesterday's statement, and what the Fed's looking at right now, maybe they're looking through this economy through rose-colored glasses, because it sounds like they're going to stick to their plan of raising rates, which is going to hurt stock prices. Us here, for one, we've been saying that the Fed needs to raise rates. They need to normalize rates, is what we call it. And we've talked about this in length in the past. So we're a fan of them raising rates and getting the ball rolling, getting interest rates back to normal. Is it going to hit equity prices? Most likely. How much? Who knows? Maybe 20, 30%, 40%. Who knows? Maybe 50%. But it's an adjustment that needs to be done. One of the reasons the economy is not getting going is the banks. They have no risk. They're not taking any risk. The risk right now, all they have basically is an electronic risk. They're receiving interest from the government. They're paying out hardly any interest to depositors, and they have no reason to lend, uh, because they don't need to take the risk when they're getting interest on their money that's held at the Fed. Obviously higher than what they're paying out to deposits. So when they lend, they lend to the most pristine, and even at that, credit rating, and even at that, it's if they even want to lend. How does infrastructure? How do jobs get created? Jobs are going to get created, unless you do a massive project in the government, a military draft, or a buildup of the military. The other way is, to do infrastructure, create jobs that way, and not just through the government. We can have private industry doing infrastructure jobs. Building roads, building buildings, what have you. Um, how do those jobs get funded? Those jobs get funded basically by banks and Wall Street, raising the capital, lending it out in all different types of forms of bonds and whatnot, collateralized mortgage obligations and whatever they could come up with. But they'll banks and the brokers firms, they'll take that risk because they know that they can get, maybe at normalized Fed fund rates, they're gonna they'll bump up the interest payments to depositors. They're only going to get so much from the government, but now they can lend out and they can make 6.5, 7% on their money, 8% on their money, depending on the project and the risk of that project. Towns can with higher interest rates, towns and cities and counties and states, they can raise more money because where the people will be willing to put their money in something where they can get 6.5, 7% on their money every year, tax free for the next whatever, call it 9, 8, 10, 12 years. Right now, what are they getting on a 2-year piece of paper? On a 10-year piece of paper, they're getting 1.7% thereabouts. So they're not willing to take that low income, and right now all the money's flowing into the equity markets. So again, if they normalize interest rates, I really feel that the economy could get started. It may hurt in the meantime, but we think it'll get started. What they've done by keeping rates this extremely low and all the quantitative easing and spending of almost $4 trillion, what has it done? It's not creating, it's stabilized the economy, but it's not creating jobs. The stock market's going up. The wealth effect created by the stock market's enormous. But what are those people doing? They're holding on to their cash. There was a survey came out, billionaires holding the most cash they've ever held in their lives, ever, since they've been tracking it. Another excuse me, another fact came out last night. The top 80 billionaires control more capital than 3.6 billion people that are on the planet. Okay, or this is what, 6 or 7 billion people on the planet. So the top 80 billionaires control more capital than let's call it half the population of the earth, half of the poorest population of the earth. I mean, think about that. It's staggering. Before, when the financial crisis hit, it took 118 billionaires to control the amount of capital that would be equal to the about 960 million poorest people. So basically, what has happened, the disparity between the wealthy and the poor has increased tremendously. It now takes less billionaires to control 3 times as many amount of poor people's capital. If I'm explaining that right, I hope so. You hope you can understand it. It just shows that the wealth, what QE have done here in the States, in Japan, and how QE is now in effect in Europe. It's just showing that it's really only benefiting the most wealthy, and they're not even spending the money. They're hoarding it because, as I said previously, billionaires are holding on to the most cash they've ever held, in actual cash, in the history of since it's been tracked. Anyway, so let's get to it. Sorry to take up so much time. I went on a little bit of a rant there. Let's get to it. We just had one trade in U.S. dollar Japanese yen, which was a full out scalp trade last night. We are in another position. We're short Australian dollar, Canadian dollar. We'll show you what we're doing and thinking there. But it's 15% of our normal size. All right. So the one trade on the U.S. dollar Japanese yen was a full position. We got a signal to go long 117.803. Again, a quick scalp looking 5, 6, 8 pips, whatever, 10 pips. Scalped it for 5.7 pips. It says here size adjusted 2.8. That's because at the end of the month, as you know, we always cut our size on approximately half. So it's approximately half of the 5.7. And you can see here it did run up to the figure, which we knew was going to happen. But at the time, you're looking at it. We haven't had a trade in a few days. It's the end of the month. You don't want to give too much back if you can avoid it, especially on a full scalp because they move so quickly. We just blew it out, and it went right to the figure, kind of busted through it by 6 or 7, 8 pips, and then reversed. and then this is all overnight. So this was last night. So we'll take it. It's not that bad of a thing to pick up equivalent of 2.8 pips. Not great, but not too bad. This is the one we're short, Australian dollar, Canadian dollar. This is a 4-hour chart you're looking at here. This is basically creating what we call a head and shoulders, or at least what we're hope is creating a head and shoulder. So this is the shoulder that was created back in the middle of January. Then you've got the head here that was created just about a week ago. And then this is the right shoulder that is creating now. And this would be the neckline, these bottoms. So the process is, we're going to short on a break of the neckline. This is a bearish formation, head and shoulders. The one thing we're not crazy about is that the head is so severe steep with this big tail up here. When that happens, the odds of a break of a neckline working out, they're not as great as if this didn't happen, this tail, if it kind of stalled out around up here around the figure of 1.0000, would give us a little better odds. But we're in it with about 15% of our normal size, and then again, even that's cut in half because of the end of the month. So we're currently down about 20 pips on this. So 20 pips, you consider that about 3 pips of our normal size. So not too bad right there. We're hoping this thing breaks down. We do have our stops in place, which is up around here, 98.80 or so. So we're willing to risk 130 pips or so, again, in 15%, it's not that bad. You're talking about 20 pips or so, which we could afford to lose. We don't want to, so we're hoping it works out. So we'll see what happens the rest of the day. If you're trading now, good luck. If any signals come out, obviously they'll be coming your way. And we'll be looking to trade again later this evening, and then obviously tomorrow. So it just feels to be able to get out have all the economic data and events and whatnot to get out of our way and be able to freely trade. So we're looking forward to it, and we'll see what happens. We do have 2 open orders, a short in pound yen and a purchase of US dollar Japanese yen. We've had those open orders for over 24 hours now. They're just not getting hit. They're really not moving. The Fed announcement just didn't create a lot of volatility. We'll see what happens going in tonight and tomorrow. Most likely, if those orders remain open, we'll most likely cancel them heading into the weekend, just because you don't want to get gapped, Anyway, so that's it. We're going to wrap it up. If you're trading now, good luck, and we'll be back tomorrow, assuming we get some action. Have a great night.